So it's a down day for the markets, which was not overdue and not really sparking any real alarm as the rebound has moved from erasing all of 2020's losses to trying to distance from the fastest bear market in history to now to the point where you want to broaden out the winners if indeed we are going to keep this rally going. Now, there are still sufficient reasons for concern and anxiety, including near-term valuations, the coronavirus trends, long-term debt or growing debt, and the U.S. presidential elections. But I got to tell you, the S&P and NASDAQ higher for the year. The question is, will the Dow join them soon? I brought in three of the best to help us out. The Fitzgerald Group principal, Keith Fitzgerald, Nicholas Wealth Management President David Nicholas, and Point View Wealth Management's David Dietz. All right, I want to start with a look at these mega cap stocks that kind of set the tone for today. Microsoft and Tesla not getting big lifts from last night's earnings. Now, listen, we can quibble over cloud growth at Microsoft or even the quality of earnings at Tesla. I think both stocks will come back. Keith, I want to know where you are, though, on these mega cap names that still set the trend for the broad market.
Well, I tell you what, it's very simple. I think quality matters more than quantity right now. I'm still very much focused on those big mega cap names. Microsoft, for example, I'm loading heavy right now because this is a bet on digitizing your life 5 to 10 years from now. Tesla's still a great play, but I think very, very volatile. I don't want to touch that one right now.
Microsoft's Azure business, 47% growth, first time under 50%. Is that raising any red flags with you? Obviously, if you're still buying, you think that's just a temporary move.
I think it's a temporary move because, again, if we look at the big picture, this is not about this technology, that technology, Windows, anything else. This is about your life and how that life gets digitized. 5 to 10 years from now, that's the real battle.
Nicholas, David Nicholas, I hear you're not as enthusiastic about these mega cap names. The run over?
Well, I love Microsoft, and I agree with Keith. I'm not selling my Microsoft anytime soon, but I think it's more about resetting expectations. I don't expect mega caps to rally in the way that they did the first half of the year, so we're just not going to see that, in my opinion, in the second half of the year. But it doesn't mean sell, right? And Keith said it correctly. Why are we owning these names? We're owning these names because they're quality and certainty in a time of uncertainty. So I like my mega caps. I want to hold them, but let's be realistic in our expectations of what we think these are going to do throughout the rest of the year.
David Dietz, it's not just these mega cap names, but I'm looking at some names that I missed. I see them pulling back a little bit. I start to get my pencil out. But with respect to the mega cap names in particular, maybe broaden it out to technology, buy the dip has only worked for the last 10 years. Will it still keep working?
Well, quite frankly, Charles, history suggests no, that generally value beats growth. We've had a great decade. That's only happened 7% of all the rolling 10-year periods, according to Fama French. And after that type of outperformance by growth, then value takes the ascendancy for the next 10 years. So from now to year end, sure, mega cap tech. But at some point, the baton is going to pass. And I think particularly as we get past this coronavirus, the economy gets onto firmer footing, investors are going to look for the laggards and so forth, and are going to look at the more value names, and there's going to be less interest in what worked during the pandemic.
All right, I'm going to come back to you later in this segment for some of those names. In the meantime, the 16 straight weeks of declines with initial jobless claims, that is over, folks. We just saw, in fact, a higher than expected climb. Now, we knew the numbers were going to go up, and it seems, though, that the market may be somewhat dispirited from that, and comments reported from Treasury Secretary Mnuchin that the administration of Republican leaders are looking for an extension of those unemployment benefits, the enhanced unemployment benefits, but they want to put something in with to keep them levered at 70% of wages. That would mean a gigantic haircut for a lot of people in this market. I go back to you, David Dietz, on this. How important is it that we get a stimulus bill, but particularly we keep getting money into the hands of consumers? And, I mean, would a haircut that big hurt the recovery?
Well, I think it's critical that a bill gets passed. And of course, the focus on that has been heightened when we saw a little blip up here in the new claims for unemployment benefits. We're looking at a big income cliff for a large segment of the population come the end of this month. So something has to happen.
Right.
I think 70%
so the $600
though, David, I think they're going to go all the way because it's going to be so important to keep this going until we get a vaccine in hand.
Okay, so $600. Let me, David Nicholas, $600. We know that's too much in the sense that people will not go back to work. I think zero is going to be too little. Where's the median that will be acceptable to keep the economy going and that the market will applaud?
Yeah, it's a good point, Charles. I mean, we don't want disincentives to work. So, yeah, I think the administration is trying to find something like a 70% wage replacement ratio. Because, again, this is more of like a natural disaster. This is something that was outside of the economy that's affecting this. So we're going to need some life support. So, again, we don't want to disincentivize work. I think we're seeing that. So I think if we can get to some type of percentage of wage replacement, right, I think you're going to see a more realistic turnaround in employment numbers going forward.
All right, but write it down. I'm saying it's going to be $300 to $400, even though the Republicans have drawn a line in this sand. Hey, the S&P 500 just joining in this last week, the NASDAQ going positive for the year. All eyes are now on the Dow Jones Industrial Average. We know it's the granddaddy of all these major indices. Nicholas, I'll go back to you because you're the chart master. What's the chart telling you? Can the Dow get to the plus column this year?
Yeah, it can. I mean, only 10 of the Dow stocks are positive for the year, so we need about 1,500 points on the Dow. So, what's going to get us there? Is it the bottom 20 that's going to get us there, or is it the top 10? I think it's going to be the top 10, because unless you have some of the names like the Disney, JP Morgan, some of these names that still haven't seen a recovery, unless those names start picking up, it's going to be the top 10 stocks that get us there. My bet's on them. That's going to get us positive for the year.
Keith Fitzgerald, I keep saying, look at Boeing. Now, it doesn't have the kind of power and oomph that it did for the Dow for years, but it's still a critical name. I think Boeing's got to get north of 200 before the Dow turns to the plus column.
I share that sentiment. The 737 MAX news is not helping the stock, but it's also a big defense contractor. And with stuff heating up with China, I think they make many of the critical platforms that our military needs and will use, even if we don't have a conflict. And I hope we don't.
All right. They've been getting a ton of military contracts. They had the stock up to 186 recently, but they keep fumbling. Hey, let's talk about the investment themes that have occurred since the pandemic began, because they continue to go on, right? Particularly in the consumer discretionary area. We're seeing a change of facing there, right? The car dealer, AutoNation, they've reported their best quarter ever. Home builder Pulte Homes saw new orders and backlogs significantly above consensus. The ITB Home Builder Index, in fact, at an all-time high. Keith, you talked earlier about making some changes. I think the pandemic has introduced new names or old names that probably should now be in people's portfolios.
I agree with that sentiment, and that's a great way to put it. It has reintroduced companies that we thought we knew a lot about. For example, AutoNation's a great one, Pulte's a great one. But, also, too, the essential, this is what I'm calling them, the essential basics, and that's Costco and Walmart, both of which are giving Amazon a run for its money. So I'm going to prefer the former rather than the latter.
David, you just kind of kicked the mega stocks to the curb, said go back to value. The market's trying to agree with you. What do you like here?
Well, so I like companies that dominate their space. The one I want to highlight this afternoon, Charles, is Tyson Foods. That stock was 95 earlier this year. Now it's 60. I think they're going to do much better than expected when they announced earnings August 3rd. They're the market leader in pork and chicken. That's not something that tech is making irrelevant. And, of course, we know what happened. There was a little slowdown on the production lines. We're going to get past that. And, of course, the company should earn close to $6 next year. This 10 times 10 times earnings for a market leader. That looks good to me, Charles.
You know what? I think I'm still in Tyson Foods. I bought it for the reasons you just described, but I've been so frustrated. With 30 seconds left, David Nicholas, anything on the value side you like here?
I like financials. I think from a quality of balance sheet play, for me, the recovery plays financials. But I also like Disney. I know my family is itching to get back to the theme parks. My girls are, me not so much. So I like a play like Disney and JP Morgan, two specific plays that I like.
All right, David, and Keith. That's more of a brokerage firm name than a law firm. I like that. David, and Keith, three of the best. Thank you very much.